Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, let's dive right into Mara Holdings, Inc. It's really become a lightning rod in the digital asset space, especially after this post-2024 halving period. We're seeing some serious compression in the stock.
Mm-hmm.
I mean, Mara is currently trading in this really narrow range, call it $9 to $9.35. Just yesterday, the volume spiked, what was it, over 40 million shares, and it tested the low end of that channel. That reflects a market cap of about $3.6 billion.
Which is a massive drop, a huge retracement from the 52-week highs.
Exactly. It's a profound retracement from highs that were well north of $23. So the central question for us is critical. Does this price reflect a deeply mispriced, leveraged call option on Bitcoin, or does it accurately price in the systemic risk of their very aggressive shareholder dilution strategy? I'm firmly in the camp that Mara is structurally mispriced right now, and it's offering some immense asymmetric upside.
See, I come at it from a completely different angle. While, the sheer scale of their assets is impressive, I'll grant you that. My analysis suggests that the market structure combined with the company's, continuous capital allocation strategy, it just creates a near permanent ceiling on the stock price. And that completely nullifies the upside you're describing. I'd argue the perpetual dilution, which is a necessary cost for their financial model, it actually makes the stock a value-destroying proposition for current shareholders. It makes it fundamentally less attractive than just holding spot Bitcoin.
Well, to really understand the undervaluation, I think we have to look past the immediate trading volume and focus on the company's underlying net asset value, the NAV. My entire thesis holds that Mara is fundamentally undervalued because the market is assigning a deeply negative value to its operational assets.
Okay.
I mean, let's just walk through the math for a second. Mara holds one of the largest corporate Bitcoin treasuries in the world. It's nearing 50,000 BTC. So if you value that treasury at the market rate and you subtract it from the current $3.6 billion market cap, the residual value the market is assigning to their physical mining fleet, which, by the way, is targeting 75 exahash per second, is deeply negative. It implies the hardware, the infrastructure, the global sites, they're essentially worthless, or worse, a liability.
I'm sorry, but I just don't buy that. I don't buy that the theoretical NAV calculation provides a true floor. The market isn't behaving irrationally here. It is rationally pricing in the risk inherent in how they finance that operation, the operational reality of dilution, It just trumps the theoretical NAV calculation every time. The market is discounting Mara because management has shown time and again that they're committed to using the stock as their go-to currency for growth.
That's an interesting point, though. I would frame it differently. The market is ignoring the crucial valuation floor provided by that massive Bitcoin treasury. We are talking about the undisputed heavyweight by hash rate capacity, and yet the enterprise value is virtually zero if you account for the treasury. I mean, this disconnect is exactly why you see these bullish analyst targets ranging from $22 all the way up to $42. They're all anticipating a massive normalization. And that upside is fueled by the inherent leverage the structure provides. It turns the equity into a highly convex bet on Bitcoin's price.
But what good is leverage if the mechanism used to create that leverage also ensures that existing shareholders never realize the full benefit? My thesis hinges on this active, aggressive financial engineering. Mara's reliance on at-the-market offerings, the ATMs, has created what I call a structural capitalization drag. The share count has ballooned, and it's projected to hit between 378 million and 454 million by late 2025. And crucially, they maintain these massive active ATM facilities, like the $2 billion authorization from last year. This isn't passive. This mechanism allows them to sell stock directly into strength, directly into rallies. They absorb demand, they cap the upside, and they fund their expansion. Sure, it strengthens the balance sheet, but it perpetually suppresses price appreciation for existing holders. The real cost of capital here isn't 0% interest. It's the continuous impairment of the shareholders' equity.
Okay, I'll concede your point that the ATM offerings do place a ceiling on organic growth over time, but your argument fundamentally fails to account for one mechanism the company can't control, and that's the violent tactical forces building up right underneath that ceiling. Let's talk about the technical setup, because this is where the asymmetry truly is. This is where dilution, at least temporarily, loses its power. Short interest right now exceeds 103 million shares. That's a staggering 28% of the public float. And on top of that, utilization rates, the measure of lendable shares actually borrowed, are consistently testing 90 to 100%. This is a classic powder keg scenario. A sustained, aggressive Bitcoin rally could easily trigger a violent covering event, forcing shorts to buy back those 103 million shares. That kind of volume would absolutely decouple the stock from fundamentals, like NAV or dilution, at least for a period, and create a massive short squeeze.
I see why you think that, but let me give you a different perspective on that short interest. That 103 million shares short, it's an imposing number, I agree, but it's not all pure directional bearish speculation. So it's not all squeezable. A very significant portion of that is what's called sticky convertible note arbitrage. Here's how it works. Mara issued $950 million in 0% convertible notes due in 2032. Sophisticated funds buy that debt, and then they simultaneously short the common stock to perfectly hedge their equity exposure.
Right, the convert arb play.
Exactly. These positions are fully hedged. They're immune to moderate price appreciation. They only become truly directional shorts if the stock price blows past the conversion price, which is, well, it's well above the current $9 range. So the vast majority of that 103 million is structural, not speculative, which means the true volatile directional short interest that could spark a violent squeeze is significantly smaller than the headline number suggests.
Even acknowledging that structural hedging, the market is still operating with extremely constrained supply. That high utilization rate proves that any fresh buying pressure, especially if we see institutional money come back looking for high beta Bitcoin exposure, is going to struggle to find shares. The presence of arbitrage actually means the supply side is inelastic. Those funds aren't selling the shares they shorted, which forces the stock to react violently upward to fresh demand, even if the arbs themselves aren't forced to cover. The potential for a tactical event is still very high.
I agree that institutional flow matters, but institutional investors are also acutely focused on operational efficiency and execution. And this is where Mara has historically lagged its peers, and it justifies their current valuation discount. To illustrate, we can just look at JT joules per terahash, the industry's key efficiency metric. Think of it as the gas mileage of a Bitcoin miner. Competitors like CleanSpark, CLSK, they consistently achieve lower numbers, often in the low 20s or even below 20. Mara has historically been closer to 30 JTH, sometimes higher. It just means their cost to produce a single Bitcoin has been higher.
That gap is a legacy issue, though.
It is a current risk, too. While their aggressive pivot to emerging cooling and this ambitious 75 EH's target are designed to close that gap, execution risk is still paramount. We're talking about a massive scale expansion that requires perfect logistics. For example, their large-scale international ops, like the joint venture in Abu Dhabi, they introduce geopolitical and execution risks. When delays happen, they often get hit with financial penalties, and that delays the revenue generation they need. Institutional investors absolutely penalize companies that promise scale but then stumble on execution, which is precisely why Mara trades at an enterprise value per exahash discount to its more efficient peers.
I'm not convinced by that line of reasoning. The pursuit of 75 EHs is a necessary scale play that I think overrides any short-term efficiency lags. Mara is sacrificing that short-term efficiency for long-term dominance. They are positioning themselves to be the undisputed heavyweight. And furthermore, their strategic choice to remain a pure-play Bitcoin miner is a huge asset, not a liability. Peers like Iris Energy, Core Scientific, they've pivoted toward AI and HPC, fragmenting their focus. Mara has largely eschewed that, which ensures the highest possible Bitcoin beta. They are making sure that when generalist crypto capital comes back into the sector, Mara will be the most liquid and purest vehicle for that exposure.
But let's look at financial discipline behind that pure play strategy.
That commitment is achieved through a controversial HODL strategy. We have to question management's capital discipline here. Mara retains the vast majority of its production, that 50,000 BTC treasury, and instead sells stock or issues debt to pay its bills. It's literally leveraging shareholder equity to speculate on the Bitcoin price. They're using your shares to make a massive directional bet.
I would call it a calculated risk.
It's incredibly risky when Bitcoin trades sideways or worse, sees a significant drawdown. And adding to that is the clear lack of alignment from the top. We've seen consistent insider selling throughout 2025, including from the CEO Fred Deal, generally in the $9 to $15 range. I mean, that activity acts as a significant bearish signal, right? The people with the most information do not appear to view the stock as deeply undervalued at these prices.
But the fact that management is willing to embrace the HODL strategy, funded by equity dilution, is precisely what makes Mara that double leverage bet. The 50,000 BTC treasury isn't just speculation. I see it as a massive, almost impenetrable break glass reserve. It provides a foundational liquidity buffer that smaller miners just cannot replicate. It's protection against insolvency during a deep crypto winter.
Impenetrable, maybe, but it's also highly volatile. Relying on a multi-billion-dollar treasury to cover future costs means they're exposing their entire equity base to Bitcoin's worst-case 70% drawdowns. That isn't insulation, that's compounding risk.
It is measured risk. And we also have to look at the financial structure you criticize, the 0% coupon convertible debt. The $950 million in notes means Mara has negligible cash servicing costs. That's a huge advantage over peers who are carrying high-interest liabilities that become punishing in a bear market. Their cost is dilution, yes, but they're raising cash at effectively zero interest to buy machines and Bitcoin. They are betting the future appreciation of both those assets will massively outweigh the dilution cost today. It is the most aggressive growth thesis in the entire sector.
And that growth thesis comes at the structural cost of existing shareholders who are perpetually running into that capitalization drag you mentioned. You're basically asking investors to trust management that Bitcoin appreciation will outpace the persistent growth in shares outstanding, which requires a leap of faith many institutional allocators just aren't willing to take, not when there are simpler, more operationally focused companies out there.
The distinction, though, is that Mara offers high beta exposure driven by its financing, whereas a company like CleanSpark offers operational alpha driven by efficiency. They serve different investor profiles, but the opportunity for tactical gain on Mara, due to its mispriced fundamentals, remains the key attraction here.
And for many, the risk-adjusted return profile of dealing with that constant financial complexity and the structural drag inherent in their model is simply not worth the hassle.
So to summarize my position, the investment thesis for Mara is really a bet on profound asymmetry. It's rooted in a deep mispricing by the market. The market is failing to price the sum of its parts. After you account for the 50,000 Bitcoin treasury, investors are getting the entire operational mining business for effectively less than free. And when you combine that fundamental disconnect with the tactical pressure of the immense constrained short interest, any sustained move in Bitcoin could trigger a violent price squeeze. It's a compelling, high-risk, high-reward tactical allocation.
And my position remains that the structural capitalization drag, specifically the dilution engine from the constant ATM offerings, creates a persistent active ceiling on the stock price that's going to limit any realization of that upside. While the Treasury provides a floor, the continuous increase in shares acts as a perpetual headwind. You couple that with justified operational skepticism and the reality that a big chunk of that short interest is sticky arbitrage, and I think holding spot Bitcoin just offers superior risk-adjusted returns. For the long-term equity holder, the financial complexity and structural drag of Mara are an insurmountable hurdle.
This discussion really does highlight the fundamental tension in valuing these complex digital assets. It's the fight between technical market pressures and leveraged financial strategy versus the discipline required for operational efficiency and ultimately shareholder equity protection.
Indeed. There are two credible sides to the ledger when you examine a high-growth, high-leverage business like this. The true value, I think, lies in understanding how long that financial tension can be maintained before one of those forces ultimately dominates the other.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.